Next, let's turn to part 2 and look at the interbank foreign exchange market and foreign exchange transactions. First is spot transaction, in which members exchange RMB and foreign exchange at contracted currencies, amount and exchange rate, and settle or deliver within 2 business days. The value date given to a transaction is the date on which the money must be paid to its parties involved. For all spot or current exchange operations, the value date is the 2nd working day after the date of deal. Before the 2005 RMB reform, spot transaction was the only type of trade in interbank foreign exchange market. Nowadays, spot transaction still plays an important role in interbank foreign exchange market. After RMB flexibility reform in July 2005, 1 month later, RMB against foreign exchange forward transaction was introduced into interbank foreign exchange market to help investors hedge foreign exchange risks brought about by RMB exchange rate fluctuations. Forward contracts refer to those whose delivery are made on a stipulated future date at a specific price. It's the simplest form of financial derivatives. Forward transactions can be outright or be a part of swap operation. In China, about 13% of margin is required to reach a forward foreign exchange agreement. On October 15, 2015, when RMB was under great depreciation pressures, People's Bank of China asked commercial banks to provide 20% of loss provisions for forward foreign exchange sales. This can help increase the costs of short positions on RMB. In September 2017, People's Bank of China abolished this policy when RMB was free from depreciation risk. The second derivative is RMB against foreign exchange swap contract, introduced in April 2006. RMB against foreign exchange swap involves 2 transactions: short leg and long leg. A short leg is the exchange of 2 currencies, that is RMB against foreign exchange, on a specific date at a rate agreed in the contract. And the long leg is a reverse exchange of the same 2 currencies at a date further in the future but another rate, generally different from the rate applied to the short leg. In China, swap contract had the following types. The first is overnight swap, whose time difference between purchase and sale of identical amount of a currency is just within overnight. Second is weekend swap, which makes a spot deal of currency and make a contrary deal to be delivered a week later. The third is 1, 2, or 3, etc. months swap, which makes a spot deal of a currency and make 1, 2, 3 months forward deal of the same currency. Next is a case study on usage of swap transaction. An exporter receives the payment of $5 million from abroad. The enterprise should shell the US dollar to get the RMB for domestic expenditure. Meanwhile, the enterprise needs to import raw materials and pay $5 million after 3 months. In this case, the company can make a swap of spot and 3 months forward with the bank. That is, the company sells $5 million and gets RMB in spot and buys back the $5 million in 3 months with RMB. The swap transaction thus helps the company hedge foreign exchange risks in international transactions. In August 2007, RMB against foreign exchange cross-currency swap was introduced. Currency swap trading is a binding obligation between the trading parties that allows the 2 parties to exchange streams of interest payments in different currencies periodically in an agreed period of time, and to exchange principal amounts in RMB and foreign currency at a pre-agreed exchange rate. So, currency swap can help control mismatch risks of currencies by switching the currency of assets or liabilities. It can also help reduce financing costs by taking financing advantages. Next, let's look at a case study for usage of currency swap. An overseas subsidiary of an enterprise needs to finance $5 million with a maturity of 3 years. But the financing costs abroad for the subsidiary are high, while the cost to finance in RMB at home is lower. The arrangement for currency swap is as the following. First step, the enterprise can finance in RMB with a maturity of 3 years, and the amount is equivalent to $5 million multiplying the exchange rate. The second step, by making foreign currency swap with the bank, the enterprise can transfer the borrowed RMB to the bank and then receive the $5 million from the bank. The last step, from then on, the enterprise pays the US dollar interest to the bank within the contracted interest-bearing period in fixed rate or at the rate of the US dollar LIBOR minus or plus the spread, and receives the RMB interest in fixed rate or at the rate of the RMB SHIBOR minus or plus the spread within the contracted interest-bearing period. Finally, in April 2011, RMB against foreign exchange option was introduced. Option is a kind of right. An RMB against foreign exchange option trading refers to any trading giving one party the right to trade, that is, to buy or sell a certain volume of foreign exchange assets at an agreed exchange rate on a given trading day. The option buyer needs to pay an option premium to acquire such a right, and the option seller collects the option premium and performs its obligation when the buyer chooses to exercise its right. This is a vanilla European option. Option can be divided into call option and put option. With a call option, the buyer has the right to buy a certain amount of currency at a fixed rate at a pre-arranged expiry date. With a put option, the buyer has the right to sell a certain amount of currency at a fixed rate at a pre-arranged expiry date. Similar to other foreign exchange derivatives, foreign exchange options also help manage exchange rate risk and control financial costs. Well, since option is a right, it has the advantage that others haven't. It's more appropriate to uncertain conditions by providing flexible choices. Then, let's look at a case study on application of foreign exchange option. An international trade enterprise needs to import raw materials and has to pay $10 million in 3 months. But it doesn't want to buy $dollar now and holds its position for 3 months. At this time, the enterprise can enter into a $dollar rice, Chinese yen 4 option trading with a bank for a term of 3 months, with an execution price of 6.58 yuan and pay for a certain amount of option premium. The results of this option include the following. First, if the spot rate is higher than 6.58, the enterprise can buy $10 million at 6.58 to make the payment. Second, if the spot price is lower than 6.58, the enterprise can waive the option and buy $dollar at the spot price to make the payments.